Are you looking to invest in mutual funds but don't know where to start? Understanding the world of mutual funds can seem like a daunting task, but fear not. By breaking down the process into manageable steps, you can navigate this financial landscape with ease. Firstly, consider your risk appetite. Your risk appetite dictates the type of funds you should opt for. An investor with a higher risk tolerance might choose a higher allocation to equities. As Sridharan S., a SEBI-registered investment advisor, suggests, a 25-year-old investor might choose a 70-30 ratio between equity and debt, with up to 40% invested in mid and small cap and 30% in large caps. For those with a lower risk appetite, the allocation to large caps might be higher and the investment in small and mid caps might be lower. But how do you evaluate your risk profile? Neelabh Sanyal, founder and COO of Kuvera, advises assessing your risk tolerance by considering your comfort level with market fluctuations and potential losses. If you're comfortable with a higher risk, equity mutual funds might be suitable. If you're more risk-averse, look towards debt mutual funds. Next, consider your investment timeline. Investing systematically rather than haphazardly can yield better results over a long period. When the market is down, use this time for unit accumulation to average out costs. Keep your risk profile, investment duration, liquidity, and tax impact in mind. It's also worth researching the fund management team's track record of performance and their approach to investors. Thirdly, consider the past performance of the fund. While the past performance of a fund is not a guarantee of future results, it can provide insight into potential returns. Compare historical returns to relevant benchmarks to get a better understanding of the fund's performance. The size of the fund is another factor to consider. A larger asset size can bring stability, economies of scale, market influence, and diversification opportunities. However, as Sanyal suggests, it should not be the sole factor in decision-making. Lastly, remember the importance of portfolio diversification. Investing heavily in one asset class or category of funds can lead to higher risk. Diversifying your investments across various categories and asset classes can potentially yield higher returns. In summary, when choosing a mutual fund, consider your risk appetite, your investment timeline, the past performance and size of the fund, and the importance of diversification. Remember, every investment journey is unique, so tailor your approach to suit your individual needs. And before making any investment decisions, always seek advice from a SEBI-registered investment advisor. Navigating the world of mutual funds doesn't have to be overwhelming. By understanding these key elements, you're well on your way to making informed and confident investment decisions. Happy investing!